So, guys, trust me, today for this book reading on deal negotiation, we have the best man for the job. And by the end of this conversation, you will definitely agree with me that no other person is suitable for this conversation, right? So, before we get into things, talking about deal negotiation, all those different terms and conditions that people do see instead of transactions that get confusing. So, I would like Ayomide to just give us a brief introduction.
Good afternoon, everyone. My name is Ayomide Jagede, right? I work as an investment associate at Browns, New York. I'm proud before working at Brownstone Capital, right? I used to work at the Chrysalis Capital, more or less an investment advisory firm for early stage startup business and tech-enabled business in Africa. I'm proud to working during my was the experience of working at Chris Harding's about to work with a couple of startups on different areas such as like M&A advisory services, right? Sales side advisory in terms of raising capital from VC fund as well.
So, guys, like I said, he's the best man for the job. You can see all the different experience that he has and the different transactions he has worked on. So, let's get right into things, right? And just reading straight up from the book, we have here that this chapter explains how deal negotiations work in venture capital, from structuring deals to understanding the nuances of term sheets. Venture capitalists build a plethora of tools to navigate the negotiation table when meeting with startups to strike mutually beneficial deals. But this chapter is not intended to be exhaustive, as structuring investment transaction involves numerous and legalities. It aims to dumb things down and keep the main things the main things. And we trust that Ayomide is also going to help us to dumb things down further. So, Ayomide, before we get into specific aspects of the book, I think the book started off with narrating a particular story of certain frustrating activities that could happen when it comes to deal negotiation. That you've been chasing a deal, you've been working on a deal, and it seems so great. And all of a sudden, a terms comes up, and it just throws the transaction off the board. So, from your own experience, what has been that frustrating experience that you had with deal negotiation?
Yeah. So I write a lot of, I mean, both good side and bad side of having to close a transaction, right? Although it's part of the game where you have to prepare for the worst case scenario in on every transactions. So one of the interesting transactions I worked on where it had to fall apart was a proposed acquisition of a fintech company in Mozambique. I worked on this deal last year, right? Basically, my responsibility was around like working on just reports, build on the financial model, and also like draw out time sheets, that transactional document that we needed to be able to close out that transaction, right? So interestingly, this business happened to be as like a lot of promising prospects, uh, including with a PSP license, right? Which sort of like helps us in order to be able to scale into that market and ultimately what's it called build a business in that market. But however, like during the whole process of events, uh we noticed a lot of discrepancy in terms of uh structure of how the firm is grounded, right? And the fact that they are pre-revenue stage, we are looking to get more higher stake in terms of equity, right? That will enable us to have controlling stake in the business and ultimately I mean is an opportunity for us to also expand into that market. So like that's sort of spanned over a couple of weeks, right? I think about 8 weeks or so, including multiple rounds of like valuation analysis and adjustments, right? And including negotiation as well. So at the end of the day, the deals fell through at the final stage, which was a bit sad for me, right? And it was due to the agreement between the parties involved, right? On this transactional change. Specifically, the seller had like sort of the last minute concerns about the proposed structure of the equity stake in the business, right? Which was sort of associated with other controlling rights as being like corporate governance and what's it called, which should be on the board as well, right? Because they also have other people that they are looking to get on the board or directors for the business, but we had other like issues around that about who should be in the board and who should not be in the board. That sort of created a lot of like I mean misfortune kind of on that kind of deal, right? At the end of the day, we are able to complete that project. Yeah, right. Well, however, I think one of the key lessons I learned from that project is there needs to be a clear communication amongst what's called parties that are involved in the particular deal right from day one, right? And not just having it on via email or via a verbal form of communication. There needs to be an agreement, right? It's sort of, although, yeah, it can start out to be like a non-binding agreement, right? Yeah, each party is aligned on what should be, I mean, the key interest on this deal, right? What will be particular equity stakes that they have to give up, right? What will be in terms of, what's it called, the controlling rights, who will be on the board, what will be like in terms of information that it's to share with us as well, especially the fact we're investing in something. Another part that I also take into consideration is to anticipate risk, right? And figure out ways to like mitigate those risks before it actually start to aggravate over time. So those are the sort of the key lessons that I actually like from that.
Makes a lot of sense, right?
Yeah.
I mean, thank you very much for that insight. And again, I think one thing that you tend to also realize is that sometimes you may think you know every single thing that could possibly go wrong in a particular transaction, maybe based upon key lessons from previous transaction. But you just find out that every transaction is unique in itself. So one just has to keep all of that sort of open mind towards learning. You just keep learning as you work on more transactions. But also something you said that is very important that leads me to my other question is having understanding of risk and having understanding of risk. And again, broadly, two different considerations for investors when they are negotiating terms, risk and their returns, right? And sometimes we tend to capture to say that many, especially in the book, we said that there are two broad categories of investment terms that investors worry about: the economic terms and then the control terms, right? For the economic terms, we talked about price, we talked about liquidation preference and all of that. So as a professional in this space, can you just help us to extend the knowledge that has been shared in the book in terms of breaking down what economic terms is all about and what control terms is all about and what the specific terms that you consider to be the most important for you or the most hotly
Yeah.
negotiated?
Okay. Thank you very much. So I mean, I will try to provide a brief summary of what the trade terms is all about, right? First of all, I'll start out with the economic term. What does it mean, right? This is basically more or less related to the financial aspect of the deal, which sometimes determine like how you investor perceive like a company, right? In terms of what the value will be like, right? Between the what's it called? Uh how the balance is going to be between both the investors and the company and perhaps other stakeholders in the business as well. So some of the key common examples of the terms there is around like the valuation, right? Which is more or less like what's called the value of the company, right? We cannot decide to be calculated either from a monthly valuation, right? That's before any sort of investment and post money valuation. There's a bit of dynamics as well in terms of how both parties look at the founder and an investor, right? So either of the two. I mean, one of them prefers to go into the deal with at the pre-money value, stuff like that. In addition to that, there are also other things like what will be how the profit is going to be distributed amongst the investors, right? And if it's going to be a preference shares or what's it called, uh, and a new investor, or is it going to be a common share? Obviously, an investor will prefer preference shares, right? As opposed to where a founder will take a common share. What will be the liquidation preference, which is more or less determining the payout or that, right? If the perhaps if the company is sold in the future, right? Or like the outcome that go was an exit event where let's say they have to close down and stuff like that. What will be the liquidation preference? I mean, in most cases in Africa, I think I've seen more 1 to 2x most of the time. In addition to that, like they have provisions of the anti-dilution provisions, right? Which are sort of protecting themselves from losing the value, perhaps like short sort of funding run as well. I don't want to get too much in that part as well. So I'll go to the other part of the that you mentioned, which is the control team. This is more or less focusing the corporate governance side and decision making power within a company. So I mean, some of the common examples that we see what's it called? One of them is the odd seats, right? Which sort of determines the investor representation within the company board, right? And what is the roles and responsibility happen as well. That was like what value addition are they bringing to the team, right? Now make them say, okay, they want to have this certain amount. People from the team to sit at the board of directors, right? Voting right as well, protective provisions, founder vesting as well, period, just to ensure that the founder is very clear and interested in the business, right, and probably kept patience over time. So in terms of waiting, in my own from my own perspective, right, I think it depends on the view context because, but if I look at it generally, I think I'll go for control times, right, which I believe that has more weight in terms of negotiation. This is why it is. One of them is in terms of the long term influence of control times, right. So, for instance, even with the favorable economic terms, right, I mean, interesting valuation for the company and everything like that. If there is lack of corporate governance, right, and between within the firm, that sort of expose the company to, I mean, that sort of strategic decision that could that could actually have an impact on their results, where maybe the likes of excessive risk taking, poor management, X management strategy, fraudulent activities that is going to relate to fair, which is the reason why what's called able cheat and also preparing on how to mitigate some of the skill risks I might sort of emanate due to during the course of the diligence. Right. Another last part to be what's it called? Um if you think about it, right, it's easier to renegotiate an economic term as opposed to a tech term. Right. The reason being is that investor, if there's a fundraising at some point, let's say from seed round, Series A, right, it's possible to negotiate for more valuation. And sometimes there might be a down valuation due to make
Mhm.
but that should be very hard most of the time to renegotiate that sort of term after other investors come into
Okay,
yeah.
so let me just come in on this aspect, right? Because you touched on a very critical points, which was part of what was argued in the book, in the sense that a lot of times people focus on those economic things so much. Oh, I have to get in at this price. Oh, this particular investment is hot. So something that is good deal for them is that it's lower priced, but failing to understand that you are going to be in partnership with this business for the long term, right? And how do you ensure that the business is steered in the right direction that ensures that at the end of the day you can exit profitably? Because no matter how cheap you enter, or let me say how affordable the deal, I don't usually like to use the word cheap, how affordable the deal may look like,
Yeah.
or lower price deal may look like, if it ends up the founder blow the money along the line, you end up losing the entire money regardless of the entry price. So it makes a lot of sense. So guys, so the next aspect that we're just going to look into, which is very critical as well, is valuation is often the most debated aspect of investment terms, which you've already touched on a bit. But then when it comes to arriving at valuations, especially for startups, that is usually very kind of difficult. And you hear people say things that is both an art and a science. And setting established traditional valuation methods like the discounted cash flow that you typically find in corporate finance, they tend to throw it out of the window. So now, from your own perspective, right, what are some of those factors that tend to influence valuation, right? And then, do you think there is a single best approach for valuing startups?
Okay. So I think there are a couple of factors that need to be considered, right, when looking at the startup valuation. One of them is the stage of the company, basically. So the way you are going to value an early stage startup business definitely won't be the same for a great stage startup. So because I mean, for an early stage startup business, they're just starting out, right? They don't have like a lot of context in terms of historical numbers and stuff like that, where you can use that to actually gauge what would be the valuation. In this case, you actually going to rely heavily on the founding team, right? And also the business idea and sort of like market potential in this case, because obviously this company is at a very many stage, right? So you have to also look up all that qualitative information and quantitative information in respect to the market size, stuff like that. Now, basically, help each other was a reasonable valuation for analytic sort of business. As opposed to a growth stage company, right? They already have a bit of traction and stuff like that. They're starting to pick up in terms of numbers. So there are a lot of information that will actually help you to fast into each other one. Early stage startup, right? So you need to consider what is like the addressable market of the business. So I've seen a couple of like pitch deck where some of those founders try to demystify what they be like. I mean, what's like the market side, and I don't think the most of them are doing really good job in terms of like really how they want to actually.
So they will just Google what's the size of an e-commerce in the world. They will just lift it. What is the size of e-commerce in Africa? So they don't necessarily, they will just use arbitrary numbers to say serviceable in food market. I can
Exactly. So like I mean, everybody wants to capture 10% of the market, 5% of the market. I'm like, okay, how exactly do you want to get to this stage? But there's no
say,
clear.
what's that buzzword again? That this is a $10 billion market and we are rated for just 1%.
Yeah. Oh yeah, I forgot the time right now. Yeah. But they want to expand to different market, right? And they are saying that okay, they believe that they should do this over the next 5 years. But if you look at it very well, they're like other countries of the market, do you think realistically we can be able to get to 5% of the market like over I mean 5 years? So those are the things I need to consider as well. In addition to that, I think the third one is team quality. So I personally, right, I have a bias towards founders that have on these businesses before, right? Because I do that in have like that's what I'm trying with them. This technical know-how and how the market goes for especially in the business space, how businesses work, especially the business space, right? So the same quality, you want to make sure that they have the right set of people on the team, right? Has what's it called? A technical know-how and product knowledge as well, financial aspect, legal aspect, they are also there out. Why they want to make sure that they have the right quality of team member. In addition to that, like I mean, this one is more specific to like a growth stage company, which is traction and metrics, right? I mean, for growth stage company where they already have a lot of like traction in the market, what's it called? It's easier to be able to tell what will be like the valuation, right? Because and you know that okay, they're doing so let's say, for instance, you have other similar companies like same market that are doing 20x multiple, right? You see this, I mean, and they did like, let's say, $1 billion worth of transaction. But the startup you are trying to look out for has done maybe times five of that. Obviously, you know that the valuation against it will be much more higher than other competitive companies, right? So those kind of three key tractions and metrics actually gauge what to be like the valuation. Yeah. I think macroeconomic factors also have an impact as well in
Especially the sort of the region where the startup is playing, right? Because again, it's just to find certain averages. Maybe what a pre-seed startup will be valued in, let's say in the US, may not be the same thing that for Nigeria due to different emerging market realities. So I mean, from what you said, market opportunity is very, very critical, and that's part of what we mentioned in the book. Market opportunity, considering certain industry averages, looking at traction, looking at certain unique technology like intellectual property that the business has, the team, like you mentioned. And like, again, why team is also very much important again because it shows predictability that this team they can be able to execute on this particular vision. And if a founder has done it before, the chances of them actually getting it right the second time, it's quite higher than for a first time person. But from what you just said, I also still hear that debate of there's no one best approach. So do you agree with the school of thought that says there's no one best approach?
yeah. So because what's it called, right? Valuation is more of an art than a science, right? I don't believe that there's a single approach to how you can actually value a company, which is why Forbes most early stage startup, right? What people do most of the time is they use a scorecard, right? Where they look out for I mean different key uh features that are looking out for in terms of the market opportunity, the products, the team, and some other intellectual property and technology, right? That will to be companies they have like rank then, right? And gauge use that to actually activate the evaluation. Although, yeah, that is also subjective, right? Because what's a VC firm? I know that VC firm might rank that's the probably higher based on that same metric, right? And there's another couple of methods also uh, started touch
Yeah.
operating companies.
Okay, so let me just cut in on that aspect because of time, right? So I totally agree with you. There are always different approaches that you want to use to consider different perspectives, and that's why in the book, I mean, several different approaches were discussed, like what you mentioned, the scorecard approach was discussed, and the discounted cash flow approach discussed as well, and the venture capital method as well. We also looked into that, but Now let's consider some of those investment instruments that is used for deal making. And again, we hear a lot of instruments, safe notes, convertible notes, preferred shares, and all of those and different instruments. And it appears that some of them tend to have their own different uniqueness, maybe certain terms that are applicable that people need to be aware of. So now from your own opinion, especially from the investor side of things, which particular investment instrument is more investor friendly? I hear people talk about safe notes being more friendly to founders than it is to the investors because it's too open ended. And people also talk about convertible notes being more investor friendly since either or instead of being so open ended, there is a time frame from which for which the convertible notes should convert, and then also the interest payments kind of adds additional incentive for the investor. And then we also have the preferred shares as well, where investors can layer different liquidation preferences and therefore protecting themselves, right? So there are a lot of debates around which one is more favorable to investors. So what are your opinions and views on that?
Yeah, so I think what's it called? If you look at it, right, I would say a preferred share is more investor friendly. Although yeah, converting notes in this case is more this most time for bridge loan, right? Before a company perhaps raise Series A and some other capital funding at some point. But I would say a preference share generally investor friendly, right? Instrument because of some reasons. One of them I would say is due to downside protection, right? So if you think about it, liquidation preference sort of ensures that investor recover the capital before common shares holder. I remember, I don't know if before we started this whole conversation, I was trying to differentiate that be an investor would definitely prefer preference shares to a share. And this is one of the reasons why they found out because they have to be settled first before the settle common share with our which in this case are going to be founders or angel investors, right? Our family implement in this case. So one of them is reasons why it is investor friendly is because of the downside protection. Another aspect is the control mechanism, right? So a preference shares with that in most cases are right, including in addition to that, like a board representation, which sort of allows investors to influence key decisions within that frame and also have baseline information so they're gaining the same as well. And I think the last one is the upside potential, right? So for the preference shares, right, you know, you what's as an investor, you're sharing in the equity acquisition while also retaining the potential treatment in exit or dividends in the frame as well. So you're not just having you don't just have your share in the business, but you also have the opportunity to gain what's it called? And uh, a steady dividend over time as opposed to what's it called? If you're a common shareholder in the business. So that's for that reason, I think a preferred share is more investor friendly than any other sort of instrument.
Yeah, makes a lot of sense, and I absolutely agree. And then, guys, there you have it. One of them, in terms of why preferred shares is a more investor friendly one, is in terms of it gives downside protection and it gives that sort of control, allows the investor to negotiate certain controls, like we made mention of, and that aspect of the sort of preference it gives them when it comes to exiting a business. It's very critical, although sometimes it yes it's investor friendly, but sometimes it can hurt founders a lot. I mean, I think I've forgotten the name of the company, but I just read about a company recently that was sued for $500 million and the founders got nothing from it. And that was because after multiple rounds, they got nothing, zero from it. So after multiple rounds, different layers of liquidation preferences layered on, and I mean, it can hurt founders a lot. So I would think that I would advocate more for investors and founders to find that middle ground. And yeah, so just to wrap up because we're almost out of time. Another aspect of investment that we tend to see is in terms of syndications, right? We see this mostly for growth and let me say late stage investments whereby the capital required is quite high, and maybe one particular investor may not be able to bring that all alone. So I would like you to just talk about investment syndication a bit, your experiences around that and why it's important. But before we get into um, um, before we get into syndication, let me just set the background just so that people are wondering what syndication is about. So, investment syndication involves multiple VCs coming together to fund a startup. This is common in growth and late stage rounds where the required funding is typically very large. To ensure orderliness, there's often a lead investor, usually the one contributing the most capital. So let me just stop it at that, and then I am there with help take it forward from here.
Okay. Yeah. So basically, from the whole concept of syndication, right, two people coming together to provide funding, right, to a particular company, startup in this case. So the way it works is this, right? There's a lead investor, right, who carry out, I will call it dirty work, like he due diligence reports, negotiate all the terms and everything, and presents the work on the investment memo in most cases, right, and just present the investment opportunity to another interested party, right? So they do most of the work and sort of set the terms of the deals, right? Where other sponsors follow and just what's it called, run on, I mean, work together with them to actually finance the company. So most of the time they often commit the largest share, right? Of the investment and sort of guide the segregation process as well. So other co-investors on that deal just rely on the lead investor expertise, right? To ensure that okay, this investor has carried out all the due diligence that gets to save them money as well because that way the co-investors don't have to go through the whole process of doing the due diligence, which in most cases is very costly and it takes time most of the time. So it's just go all in. It's just like a case where you have a driver that is leading you that okay, this is where you're getting together and you are just like a passing down, just following in the direction of the person. That's basically the way syndication will up, right? So the co-investors might actually take an active role, and sometimes they didn't actually take an active role in these cases. And so, in addition to that, like there's a bit of legal and financial coordination as well, which is mostly and the investor living skills, right? Since they already have very unified investment agreement with the startup as well. So some of the key, there's some key benefits and sort of the merit of syndication is just like I mentioned, one of them is shared risk. So considering the fact that a lot of couple of multiple investors are coming together, right? That sort of spread the risk across like other investment frame and helps within the sort of exposure, right, for each of these participants that are involved in this transaction, which is more, which sort of makes it more easier to invest, especially with the higher risk style in this case, right? That's one of the key benefits. One other key benefit I can think about is diverse expertise, right? So syndication boosts the time brings together like investor with different skill sets, the network and industry needed, which sort of extra hard value to the opportunity as well. Another part is focus support, right? In terms of I mean, stronger support to the startup, like providing like what's the I mean, I think I mentioned that in terms of diverse expertise. But I think the interesting part about it is that it helps to most time reduce expenses out where just like the process the then space where the investor already requiring right. That sort of reduce the expenses that be incurred by other co-investors. But however, there are also some key challenges, right? One of them is in terms of nation. Because I mean it might be difficult in most of the time to manage the process. Let's say in the case where um, there are different investment theses that these co-investors actually have, right? And the lead investor perhaps have a different opinion on how it needs to go. Yeah, try that might take you a while per day in terms of exactly negotiation process takes a while because like though yeah, they are the lead investor making
Yes, and sometimes can be very exhausting for founders as well. So sometimes that process can be very exhausting for founders, and it's best for them to focus on the lead investor and for the lead investor to just and speak on behalf of every other person. So I mean, this has been a very interesting conversation. I know if we had like 1 hour, 2 hours, we'll definitely delve in more. I believe sometime around the future when we'll have a more focused conversation for this and this topic, I really appreciate it. Thank you very much for the insight shared. I myself I have learned a lot. So my dear viewers, I know you've learned a lot. So what are you waiting for? Get the book 365 Days in Venture Capital. Just go to www.365daysinvc.com. Thank you so much, Ayomide, for your time. I really appreciate it. Fantastic, fantastic.